timing the markets is extremely difficult. So rather than trying to endeavor towards that, I think it's better to stick to the broader goals. So if machines were able to identify the linkages, then they may be able to solve the market. So that's the future. Extremely difficult to actually have the gumption and the guts to put money when the streets are bleeding. Less developed part of the country in terms of advancements in finance and advancements in investments probably still don't see market investments to be a safe haven.
They think it's gambling.
There were times when our villagers were distrustful of banks because they thought that money kept in a bank would actually vanish, while it was a lot more lucrative to be putting money in bank rather than keeping it in your house, because at least that would return inflation rate. Right? And equity markets need to do that final level of education to the people who actually perhaps need it the most, because those are the people who will actually be able to come out of, their or improve their standards of living significantly if they could financialize their savings.
Hi and welcome to another episode of House of Equentis podcast, where we decode all things tech and finance for you. And today we have with us Mr. Shankar Krishnan, who is the head of Quant Strategies at Magma Ventures. Let's welcome him. Hi, Mr. Shankar. How are you today?
Very well. Thanks, Merlyn. Thanks for having me here. How are you?
I'm very good. Thank you so much. Shankar, I went through your LinkedIn today, and your bio was quite captivating for me. It states that you are passionate about marrying quantitative finance and long-term investing. Can you tell me more about your journey towards quant finance and more about your passion?
Sure. So I would say this was kind of happenstance rather than a planned move into this direction. So a bit of my background is I graduated in engineering from NIT Nagpur and subsequently went to IIM Indore for my MBA, and my first job out of campus was with a startup which was dealing with quantitative finance related stuff, targeting certain markets, not India, but North American markets, European markets. Back when I chose to take that job, the thing that drove me towards that job were not really that it was involved in quant finance, but the fact that it was involved in finance, which is what I wanted to do. And most of the courses I took up in my MBA were finance related. And I wanted to work in a smaller organization because I think that was the time when the startup culture was kind of picking up. This was back in 2013. So I think we were in the crossroads between deciding whether we wanted like a branded name or you wanted to work in an organization where you could direct more change. And that's what I wanted to do. So that was my choice or my decision. That's what led me to that role. That company was kind of right at the cusp of lot of interesting innovations happening in quantitative finance.
When was this?
This was in 2013.
Okay.
And this was about the time when quantitative finance was becoming the mainstream in the West. Right? And this company happened to be catering to exactly those markets where this style of investing was picking up.
Okay.
And because it was a startup, I was kind of donning multiple hats there, but a lot of my time went into designing strategies. And that's kind of what drove my passion into the space. I spent about 5 years there. And so within finance, there is this bifurcation between the sell side and the buy side.
Correct.
And sell side is largely got to do with designing strategies, but not directly managing money. And the buy side actually deals with managing money. Right? So this company was squarely on the sell side. It wasn't managing anyone's money. It was just creating strategies and selling those strategies, which gave me exposure to a variety of different strategies, but I wasn't managing money back then. I had a small stint at Morgan Stanley Capital International in Bombay, subsequently, which was again a sell-side organization. At which point I kind of pivoted onto the buy side because there was this itch in me that I wanted to really put into practice the things which I was selling, the things which I was creating. Because in the sell side, what typically ends up happening for a researcher or someone who's designing strategies is you keep designing one strategy after the other. And you forget about the last strategy once you move on to the next strategy, right? But that's not how real life works, because real life doesn't give you an opportunity to trade multiple strategies all the time continuously. So you really need to kind of go through the entire life cycle of not just developing a strategy, but also managing it and upgrading it and improving it and so on, right? And the real life friction that are associated with actual money management. And there is a kind of, so if you are a sell side researcher, typically there isn't a whole sense of accomplishment if your strategy does phenomenally well, because this is one of hundreds of strategies which you have developed. But that sense of accomplishment is definitely there if you're on the buy side, because that's pretty much the thing that you're managing, right? So at least that was my main motivator to move into the buy side.
Okay.
So my first stint was with a hedge fund based in Bombay called Alpha Alternatives, which is right now, back then not as large as what it is now. Now I think managing close to upwards of $1 billion in assets. So I subsequently had a short stint at Morgan Stanley Capital International, which was again a sell side role. But there was this constant itch to actually move to the buy side, because there is this additional sense of fulfillment, at least for me, in being able to see how the strategies which I have developed actually perform in real life, and what is the actual outcome for an investor who's invested capital in that, right? Which drove me to join this company called Alpha Alternatives, which is a hedge fund based in Bombay. And I think they're managing about $1 billion now. They weren't as big when I joined them. And I was managing a small allocation there through the techniques which I had trained myself on earlier. And I was actually looking for a larger remit, a larger mandate, because of which I got an opportunity to set up the hedge fund business at Motilal Oswal Asset Management Company. So I moved there, spent about 3 years setting up the infrastructure, setting up strategies, raising capital and things like that. Subsequently though, when I was kind of closer to the end of my stint at Motilal Oswal, the reason why I kind of wanted to kind of move from there was the fact that when you're managing money in a regulated setup, and the fund that I was managing belonged to a category of funds called AIF, or Alternative Investment Funds.
Can we explain that to our users?
Yeah, so alternative investment funds are like mutual funds, except that the target audience is high net worth individuals. So there's a minimum ticket size that you need to invest in them.
What's the minimum ticket size?
Mostly it starts with 1 crore, but it can vary from fund to fund. So it can be more than that as well. And you get a chance to kind of trade differentiated strategies. So you don't necessarily need to just buy a certain company or a group of companies. You can also kind of do some kind of hedging. So you can actually use certain derivative instruments like futures and options to hedge the portfolio so that the downside risk is protected.
Okay, I think there are too many jargons thrown at right now. So let's talk about hedging a portfolio.
Right.
Can you explain that in the simplest sense?
Right. So think about it this way, right? When I have an equity portfolio, right? An equity portfolio is nothing but a basket of stocks.
Correct.
Now, the stocks can go up, the stocks can go down, depending on the market dynamics for that particular company or those group of companies. Typically, any investor, if you gave them a choice, they would want the upside, but maybe not like the downside as much. And hence, if I could give them an option saying, you know what, if the portfolio goes up by 10%, you get that.
Okay.
But if the portfolio goes down by 10%, I protect that fall. So you don't experience the fall in the portfolio. The concept of doing that, or the style of doing that, is called hedging. Now, this is an ivory tower. This is the ideal world where hedging is costless and you can pretty much hedge anything that you want. Typically, it doesn't work like that. There is a cost associated with it. The cost can come in many ways. It can come in the form. So think of it like an insurance, right? So think of it like you're buying an insurance to protect the value of your portfolio if it falls down below a level.
Correct.
Right? Now you have to pay for the insurance. Now, if you're paying for the insurance, oftentimes what ends up happening is that the portfolio doesn't go down. And hence, like insurance, what ends up happening is the premium has been paid. but you don't reap any rewards. So that's kind of the counterbalancing force, if you want to say that. That's basically how it works. So it compromises some returns on the upside with the added benefit that you get protection when the market is not in your favor or your portfolio is not in your favor. I hope that
That did.
Okay, all right.
Okay. Let's talk quant finance.
Right.
I mean, for a layman out there, I think it's difficult to understand what is quant finance unless you've studied about it or you're working on
Sure.
it. So can we explain quant finance to a layman investor out there?
Sure, absolutely. So quant finance is a very broad term. So let me maybe focus on the subset which I am most closely associated with, which is quantitative investing. So investing basically, and let's talk about equity investing, right? So equity investing means deciding a set of stocks that you want to buy.
Correct.
In the simplest terms.
Correct.
Now, how do you decide which are the companies or which are the set of stocks that you want to buy? Now, if you went to a mutual fund manager, a typical traditional mutual fund manager, and asked them this question, they would typically say, we predicate the growth of a particular company.
The fundamentals of it.
Yeah. No. So there could be a mandate that the fund should have a defensive characteristic. Typically, there could be a mandate that the fund should invest in a certain sector. There could be various mandates. But broadly, you're looking to invest in a set of companies which meet certain criteria.
Set of good fundamentally strong
companies. Fantastic. Right? But this criteria and the way of application of this criteria need not be very systematic in nature.
True.
Meaning, I could say that I would like to invest in a company which has a 15% return on equity, for example, in its operating business.
Okay.
That could be a rule. But as a discretionary or a traditional fund manager, if a company which I otherwise like, because I like the management of the company, I have seen the track record of the CEO and so on, has returned 14.5% for a year, do I necessarily kick that company out? Maybe not. No. Right? Yeah. Because I have that comfort factor. I believe in the sectoral, tailwinds that may be supportive and so on. And hence I go on and invest in this particular company. And I create a portfolio based on a collection of these different companies.
Okay.
This is how a traditional manager would do it. A quantitative manager, on the other hand, tries to remove any kind of discretion to the extent possible. Which means if I say that my rule is that I will not invest in a company which has less than 15% in return on equity, even if a company returns 14.999%, but numerically it is less than 15%, that company doesn't get selected.
Right? That really happens?
Yeah. In a quantitative style of investing, it happens.
Okay.
Which basically means the biggest difference is the quantitative manager is not really picking one company after the other and deciding whether to invest in it or not. Typically, what the quantitative manager is doing is quantitative manager is looking at a large bouquet of all the possible offerings that are out there. All the companies, maybe the top 500, top 700, you define your universe. You apply various criteria and you come down to a subset of companies.
Okay.
What happens as a result is you may end up with a set of companies which may not even be looked at by the traditional manager. Because the traditional manager, cannot possibly have an expertise on 50, 100, 200, 500 companies. They may have an expertise on maybe 15, 20 companies, and they may want to choose 5 out of those 15 or 10 out of those 15, right? A quantitative manager doesn't need to have expertise on even one company, because a quantitative manager is just designing a process to select companies which are cast in stone. Because this process is cast in stone, it is a repeatable process, and you basically keep doing it, rinse, repeat over a period of time. You decide the frequency, you decide whatever you want to do, put that into the set of rules, and then you follow the rules. So there's no emotion that comes into play. If this process ultimately leads to a company which you don't like personally, too bad for you. You still have to buy that company. So that's what a quant manager would do. A discretionary manager, on the other hand, does not operate like this. A discretionary manager is going to apply their discretion.
Okay.
Right? Now, why would you do this is a natural question, right? The reason you would do this is because oftentimes humans are guided by emotions.
Absolutely.
Humans are guided by their own biases. And biases are things which have actually helped us survive and evolve over a period of time.
Correct.
So, and this is something which I have done as an exercise when people have asked me a similar question, is typically, two windows are shown and in a picture, and there's kind of an optical illusion, and the viewers are asked, which window is bigger? How would a human make that choice? The human is going to visually inspect and see, this maybe looks bigger than the other one for whatever reason, its size looks bigger, whatever, and may make their choice as to window A is bigger than window B. But how would a machine do it? A machine does not have eyes.
Correct.
Right? The machine is actually going to measure the area. And when you measure the area, no matter what level of optical illusion you have, ultimately if the area is the same, the answer that is going to get returned is that the area of the window is the same. So there is no difference between the sizes. Or if one is greater than the other, then the machine chooses that. So that discipline is traditionally lacking in humans because of how we have evolved as a species, which is where quantitative investing kind of trumps a traditional investor. So this is the benefit side of quantitative investing. And why is it picking up? It's picking up because, 15 years ago, 20 years ago, there wasn't a lot of data that was available. Compute power wasn't as high as what it is now. Right? So even if I had a hypothesis, there was no way I could test the hypothesis. There was no way I could know if I had done this in the past 15 years, how would that strategy have done? But today, that's not the case. Today, I have almost infinite compute. I have so much data that becomes difficult to kind of capture, read properly, which makes it more difficult for someone who's looking at data in a more ad hoc manner to come up with better decisions as opposed to a machine which is able to make these decisions in a very non-emotional way. So that's, I think, in a nutshell, what quant finance is all about, or quant investing is all about.
Now, again, quant finance is touted as the future of finance. What do you think the future looks like for this particular realm?
So the end goal is, of course, that you have machines which are smart enough to create their own rules. Right? So today, the portfolio that I create are largely governed by the rules which I have designed.
Correct.
And the machine is just doing the job of replicating those rules in a timely manner, periodically. The future, the optimal future, is for the machines to come up with the rules themselves, because the argument extends that I can only decipher so many patterns. My mind works linearly. Humans can't really grasp exponential changes, but machines can do that. So if machines were able to identify the linkages, then they may be able to solve the market. So that's the future.
Okay. Let's talk about your role at Magma Ventures. What is it like? Tell me about your day-to-day life. What do you do?
Right. So at Magma Ventures, I'm heading the entire Quant Strategies allocation, which the prop fund has. So my team and I, we are responsible for generating a suite of these kind of strategies, which are required, or the objective of designing multiple strategies is so that they can cater to different types of market conditions.
Okay.
Right? So a significant amount of my day-to-day goes into reading stuff, which may be slightly related to my end goal with respect to how the scientific or academic research community has kind of tried to solve that problem or a associated problem, and if I can use some of that in my particular use case, or trying to see if there is someone else who is kind of also encountered a similar problem and found some novel solution which I can kind of use. Because no two problems are completely alike, but you can gain insights from someone else's solution to a slightly related problem and apply that to your particular use case.
Do you mind telling one of the problems that you solved?
Sure. So, without trying to get too technical,
let's not get too technical.
Yeah. So there's this concept of having a portfolio which is not tilted significantly in terms of its sectoral allocation.
Okay.
Okay. Now, the simplest way to do that is that you cap the number of companies which come or which belong to a particular sector. But is that the most optimal way to solve that problem? Because, is it right to, choose 5 companies out of 15 possible candidates based on certain score? Or do you want to take exposure to all those 15 candidates, but change the allocation amongst them in a manner that you are able to capture the essence of the sector better, but still constrain the overall exposure of the sector in your portfolio? Now, there's no absolute truth to this problem. Different people can solve it in different manners. What, as a quant fund manager, what I'm interested in seeing is how have those multiple different approaches turned out for the people who have applied them.
Okay.
And which of those outcomes is most conducive for me and is helpful for me to kind of manage the kind of risk return profile which I want to manage in my fund. So there could be multiple approaches. I choose one of those approaches. But I have to evaluate all of those, or at least I have to see what are the different possible approaches so that I can evaluate them.
So I remember during the election time, I think the markets were extremely volatile. I think the volatility index actually shot up to 30, and it was not really a good time. And of course, investors, especially new investors, are usually spooked by it. Now, what advice would you give them to an investor, especially in a challenging market environment?
I think it is the easiest job to give advice, so long as you are not actually faced with that kind of volatility. And it was a tough time, don't get me wrong, right?
It was very like a small period.
Yeah, for a very small period.
Yeah, the markets are like booming right now.
Exactly. Now, I actually, rather than talking about elections because they were very short-lived, I'd like to give the example of COVID, which is perhaps still fresh in a lot of our memories. When when Nifty level was at about 7,700, there was this conversation with a lot of us were having, and a lot of the people involved in the conversation were people who were market veterans for the last 20, 25 years. And the consensus that emerged out of that room was market is going to go down to 6,500, right? And market has not looked back from 7,700. It's just gone up, right? Now, if the smartest people in the room or in the country or whatever you may want to call them, collectively agreed that 6,600 is what looks rational, obviously nobody is going to increase their equity allocation at 7,700, right? Because there are still legs to go for the drawdown. So a lot of people actually lost out on a generational buying opportunity. So the point that I'm trying to make is, it's easy to, sermonize this and say, stick through volatility, increase your allocation when drawdowns are high and things like that. But that's very difficult advice. Like very difficult advice in practice, because it's extremely difficult to actually have the gumption and the guts to put money when the streets are bleeding. But
that's right time to invest.
That's the best time to invest.
Best time to invest.
That's the absolute best time to invest. But if the sharpest people on the street don't have the gumption to do it, it just becomes an academic exercise to say you should do it. But whether one actually does it or not, there's a big difference between the cup and the lip, right? So I would in fact then say, let's not worry about volatility. Let's just keep stuck to our broader asset allocation goals, because even professionals don't get it right. So timing the markets is extremely difficult. So rather than trying to endeavor towards that, I think it's better to stick to the broader goals, not deviate too much. When you're allocating based on your targets, right? You're automatically investing more when the markets are down, right? Because let's say you have 100 rupees of capital and your target allocation to equities is 50%, right? Now your portfolio is actually below 50% in equities because markets have tanked. Now you have to get it back to 50%, which means you're actually investing more at that point in time. So I think rather than trying to see, oh, market is very volatile, let me not invest money, or market is looking extremely overbought or oversold or whatever, and hence let me invest more or not invest more, rather than taking those calls, I think it might be more conducive and it might be more lucrative to just stick to your longer term goals in terms of broader asset allocation.
I think that's the thing. Time in the market is more important than anything else, than timing the market.
Absolutely.
And even if I've done my own research, I've seen periods of the COVID crisis, the dot-com bubble crisis, and we've seen geopolitical crisis, and markets have always recovered.
Yeah.
And I feel like, this is something a layman wouldn't understand because there's no education as such.
Right.
So how do you think we can educate more people to get into the market and, to also calm their nerves, especially during these periods of market volatility?
Right. Actually, credit where credit is due. I think the general asset management industry and the wealth management industry in India put together have done a good job in educating masses to some extent. That we see monthly SIP inflows of 20,000 crores, the number which everybody loves to talk about. That number is not significantly coming down. What does that mean? That means that when you have set yourself on a path or on a trajectory towards allocating capital into markets in a certain manner, you're sticking to that around market volatility. You are not decreasing your allocation to a particular asset class because of fear mongering by whoever is mongering the fear, right? So I think credit where credit is due, the industry has done a decent job. But having said that, financialization of savings is minuscule in our country. People in the outer rungs of our society, in terms of being in a tier 3 or a less developed part of the country in terms of advancements in finance and advancements in investments, probably still don't see market investments to be a safe haven.
They think it's gambling.
Exactly. So I think there's a lot more that can be done. I think that I remember reading about it, that there were times when our villagers were distrustful of banks because they thought that money kept in a bank would actually vanish, while it was a lot more lucrative to be putting money in bank rather than keeping it in your house, because at least that would return inflation rate, right? And equity markets need to do that final level of education to the people who actually perhaps need it the most, because those are the people who will actually be able to come out of their, or improve their standards of living significantly if they could financialize their savings. Correct. From putting it in deposits to putting it in avenues which may be more lucrative in terms of yielding returns.
Education is important.
Yeah.
Education. Like you said, 7,700 to about 28,000 levels right now.
Yeah.
I think that's also kudos to all the, education platforms, even to influencers to some extent, that actually propel this growth. And we ourselves have something called Informed Investor, where we just educate investors about, the markets in general, the stock market in general. So I believe things are happening and good things are happening. So, and we've also been doing something to propel this growth. Okay, so let's talk about macroeconomic factors. You've got your GDP, you've got your inflation, you've got your interest rates, and especially inflation, interest rates have been the word on the street for about 3-4 years now. Inflation going up, interest rates going up, there's expectations that it will come down, and we've not seen a rate cut even now. Yeah. So tell me more about how you use these macroeconomic factors in assessing your investment decisions.
It's a very interesting question, close to my heart. Unfortunately, don't have an easy answer. Because we did quite a lot of studies on trying to isolate the impact of various macroeconomic variables to the behavior of certain strategies which we were running. And what we found was there was significant dispersion or significant differences and discrepancy in how a particular macroeconomic variable impacted a particular strategy at a point in time. So the same variable, let's talk about inflation, may have positively contributed to the performance of a strategy at a particular point in time, but have also contributed negatively to the performance of that strategy, or not as positively at a different point in time. So there was no consistency. And there could also be the case that what worked in one geography, so what worked in India, may not have worked in the US and vice versa, right? And then we tried to dig deeper to try and understand why this is occurring, because it seems as if it should work in a certain preordained manner. What we found was that oftentimes there isn't one event macroeconomically which is driving anything, because it is joining a lot of other things which are also happening simultaneously, and the linkages kind of contaminate the final impact on your particular investment. So inflation could increase on account of war. It could also increase on account of too much demand. And these are completely contrasting outcomes, right? These are completely contrasting effects. So how do you give importance to the inflation number without taking it in the right context is the point, right? And we have been having the war narrative for a really long period of time. We have not got out of the first war, we have already gotten into the second war, right? So it's very difficult. Like investing based on macroeconomics, at least to whatever evidence I've tried to accumulate or I've tried to collect, I have not found consistency in using macroeconomic variables significantly to guide my investment decision making. Having said that, one way in which we are using it in our models is, linking back to the first question you asked, which is what is the final end goal of Quant Finance, right? And I told you it's machine learning, trying to figure out stuff. What we are doing actually is we are feeding a lot of these macroeconomic variables to our machines and letting them decide on allocation for us in terms of how to allocate to different strategies. Because arguably, the machine is able to identify linkages better than I can in my mind, right? So that's how we are using macroeconomic.
Can you give me an example when you say linkages with your...
Yeah, so the easiest way to explain it is maybe using a variable called debt to equity.
Okay.
Right? Now, debt to equity is basically how much debt the company has taken.
Yeah, income.
Now, too much debt is bad.
Correct.
Because it brings the sustenance of the company to question. But is zero debt very good? Maybe not. Because maybe it means that the company is not optimally utilizing its capital, because the cost of debt is typically cheaper than cost of equity, right? So you should be having some level of debt. What is that correct level of debt? Humans are geared to think linearly, right? So humans may think, okay, low debt to equity good, high debt to equity bad. We can think linearly. But we may necessarily not be able to think, okay, a 0.7 debt to equity is, maybe the sweet spot. Uske upar, above that, it's kind of a non-linear impact. Below that, again, it's maybe a U, it's not a straight line in terms of the impact to the stock price or impact to performance or whatever. A machine can figure that out.
Okay.
Because there are algorithms which are able to take care of the non-linear impact between variables. And this is just one variable. Now imagine there are tens of variables which also impact each other, and they eventually also impact the stock price. Now with one variable, we can't figure out the impact. Humans can't really figure out the impact, and hence our decision making is only based on heuristics. We broadly say, the debt to equity is so much, the return on equity is so much, and hence it's a good company. But maybe there are nuances to it, there is a better pattern to it which we can't decipher. The machine may be able to decipher that. So that's how we are using machines in our investment process.
Now with all of these strategies all of this draws down to, the fundamentals of something.
Right.
And let's talk about India's fundamentals as such. How is it looking right now?
So before I answer that question, I would like to preface it by saying that, don't take my word for about views on economy, views on market, etc., because there's a running joke in the community that quantitative portfolio managers don't even know the companies that they own.
Is it true?
Yeah, and it is true. So we own basically in our funds, we own more than 200-300 companies. And if you ask me about a particular company, there's a very high likelihood that I may not be able to tell you whether I own it or not, right?
Okay.
Because I don't care whether I own a particular company. I only care about diversification. I only care about having it in my portfolio because it meets certain characteristics. Now, you replace that company with another company with identical characteristics, I don't care. I'm happy to pick that company up as well, right? So I will preface my argument with that. Having said that, India is looking on the fiscal front, fantastic. Maybe inflation largely controlled. You're just waiting for...
It's just external factors. With inflation,
external factors perhaps look like the only risk, and external factors won't only impact India, they will impact everywhere. But the problem I feel with respect to valuations is that I think valuations have also priced all these things. So it's not like valuations I think are priced for perfection.
Yeah.
So any negative news, it could be that there is some small slowdown which is happening in some quarter, which starts showing itself or starts rearing its head through some non-standard indicator in some pocket, and that leads to some selling pressure. And the pace of 20,000 crore monthly SIP inflows, which we keep talking about, does not sustain because there are more outflows. If some of that happens, maybe there is some downward pressure, but I don't know if that's in the horizon. I don't see it in the horizon at least. And as far as the external factors are concerned, it's anyone's guess. You never know. There is a lot of, truth be told, there is a lot of instability even in the developed part of the world, political instability. You don't know what's going to happen in US elections. So it's anybody's guess, honestly. But ramifications will be heard everywhere. So it's not going to be India specific. The risk definitely doesn't look to be India specific. It seems to be more global.
Correct. And so despite all of these challenges, we're still doing well. The Indian markets are hitting all-time highs.
Yeah, absolutely.
Yeah. So one more question. Do you think somebody who wants to invest in the stock market should go to a SEBI regulated investment advisor?
No, 100%. No question. So my reason for this is simple. When you are a SEBI registered investment advisor, and you're investing with a SEBI registered investment advisor, basically you are coming under the ambit of SEBI, and SEBI has certain regulations with respect to how a fund should be managed.
And they're very conservative.
And they are conservative, right? So so this is hard-earned money, right? So when you're entrusting someone else with hard-earned money. There is an ombudsman in the form of SEBI, which is going to look after, any wrongdoings that can potentially happen if it falls under their ambit and their remit, which is not going to be the case if you go to an unregistered. And by the way, unregistered advisors I don't think they're allowed to take money. So if they're doing it, I don't think they're doing it legally. So and that's also the gray area.
Okay. So tell me more about the psychological aspects of investing. And also, could you please advise people, especially adopting a long-term approach in today's market environment?
Right. So, as a quant, or part of you could say, in hindsight at least, as a quant fund manager, I am actually very far removed from trying to manage my psychology because the machine is doing it for me. So, even if I'm psychologically not up there in terms of being able to efficiently and adroitly manage money, doesn't matter because I'm not anyway doing it, the machine is doing it, the system is doing it for me. So I don't have the problem of having to manage my psychology. But there's a difference when I'm managing money versus when someone is investing their money in the market, into a fund, into whatever, right? And I think we spoke about it earlier, but it's very important to have your larger goal in mind.
Correct.
Because it's very difficult to control your emotions, control your psychology. So there can be two different types of problems, right? So one problem is, how am I doing absolutely? And the other is, how am I doing relatively to the other person? So if I was in a 2023 kind of market and I made 20% returns, which is great, but my neighbor made 40% returns, I feel bad. So there's an element of psychology that needs to be put in check and controlled there. And there is this question of, market is down 30%, I am down 20%, or I am down 30%. then there isn't so my goalposts have now changed, because now I'm no longer looking at how my neighbor is doing. Maybe my neighbor went down by 50%. I don't care about that, because I have lost 20% or 30% of my wealth myself, right? So it's difficult. I think what is most important is to, rather than trying to refresh on a daily basis, have a clear objective with respect to what your broader allocation goals are like, what your allocation targets are like. And I think your allocation goals and targets tie back to what your goals in life are generally.
Correct.
And stick to that, right? So just use these instruments as means to achieve that objective over a long period of time, because there is going to be volatility on a day-to-day basis.
For sure. Okay. Now the professional questions aside, let's get to the personal side of it.
Right.
Now your work seems quite demanding.
Right.
How do you do this entire work-life balance thing?
Right. So I guess it's as demanding as any other job. I feel it's but part of it is also over a period of time one grows to start liking what one is doing enough that it doesn't feel to be a burden. So I think that I was lucky enough to be in a field which I've come to enjoy. So it doesn't feel as if I'm overextending myself. There is a lot of emotional satisfaction in trying to read up, trying to study, trying to uncover new developments, new enhancements, and seeing how they fit into the market puzzle, and trying to solve that, trying to unravel that.
That is interesting.
Yeah.
Yes.
So there is a lot of satisfaction that one gets out of it. And then be clear that, there is a certain amount of time that you need to devote to the other aspect of your life, which is your family, which is your friends,
How do they support you?
So I feel family supports you. Friends keep you grounded. And I guess mentors pave the path for you, kind of instruct you as to how to go forward. So I think they play a very important, at least in my life, all three categories have played a very important role. I couldn't have done whatever little I've done without their impact and influence.
Okay. How do you keep your mental health intact, especially during tough times? What do you do? What are your hobbies?
Yeah. So I'm very particular about physical activity. I play badminton, so I do it quite religiously. I have a trainer and try to not miss any of my sessions. I have a close-knit group of friends whom I meet very frequently and religiously. And there's a time that is allocated to family which I don't compromise for anything else. So I guess these things I do no matter whether I had a good day in the market or a bad day in the market, or a good month or a bad month. I guess that helps me kind of retain some sanity.
Do you carry work home?
I don't carry work home in the sense that I don't sit on my laptop and do stuff, but I check markets in the morning, the first thing I wake up.
Yeah.
So to that extent, yes, and that is work for me, right? So to that extent, yes, I carry work home, but I try to kind of have too much of an overlap.
Do you like rapid fire rounds?
I haven't participated in too many. I'm a bit anxious.
Okay, then let's do this now.
Okay.
All right. What's your favorite book?
I don't have one favorite book. Across genres, I guess The Man Who Solved the Market, which is about a person called Jim Simmons, who runs a fund called Renaissance Technology, recently passed away. It's the most successful fund out there. So it's about him, it catalogs biographies. That's non-fiction. Fiction, recently I'm reading J.K. Rowling's Cormoran Strike series. I don't know if you're aware. So it's about a detective called Cormoran Strike, who goes about, he's a private detective, so he goes about solving cases. Nice. And she wrote it with a pen name called Robert Galbraith. So
nice.
Quite interesting.
Okay, any favorite movies?
So the one that has stuck the longest with me is Shawshank Redemption. But I also like a good whodunit. So Usual Suspects is one movie which I like a lot.
Nice. Any TV shows that you're watching right now?
Right now, I actually started on this show called Sugar,
Okay.
on Apple TV. It has Colin Farrell, I think.
Okay.
He's a private detective in the US. Interesting show, but I've just gone through the first couple of episodes.
Okay, done. How do you prefer learning new skills? Reading books or watching tutorials?
Reading books to understand the concept, watching tutorials to have to get a sense of the actual implementability of it.
Done. How would you describe yourself in one word?
I wanted to say tranquil, but I don't think I am.
Would your friends agree with it?
I guess they do.
Then
Yeah.
tranquil it is.
Yeah, maybe tranquil above the surface, beneath the surface like a duck.
Okay. All right. Top 3 essentials for building a strong brand presence in fintech.
Right. I guess good, knowledge base to be able to communicate, and good knowledge base, A. B, ability to communicate well with a diverse set of audience. And 3, I guess, speaking the language of a techie and of a finance professional, both.
Okay. I think I know the answer to this question. Stocks or bonds?
Stocks.
Bull market or bear market?
So very interesting what someone told me. I actually run long short strategies. So they actually work well in bear markets more than in bull markets. But in bull markets, one of my mentors told me, bull markets, everyone makes money. Bear markets, maybe you make money. So I'd rather have everyone make money.
That is true. That's very sweet. Technical analysis or fundamental analysis?
Statistical analysis.
Favorite financial author or book?
So I want to say Michael Lewis. So he wrote a book called The Big Short. He's written multiple books. I think he's wrote one called Big Short.
The movie, yeah.
The movie is based on the book, yeah.
Okay. Are you a morning person or a night person?
Naturally a night person, but I recently had a baby, so I'm a...
Oh, nice. Congratulations.
Thanks. So I'm up all the time person.
And which is your favorite financial market to follow? The US, India?
I trade India, so Indian markets.
Okay. And biggest investment win so far?
So I don't know biggest, but so I'll talk about 2. One is more personal. I was actually one of the few guys, I spoke about the COVID crisis and 7,700 market and people saying it may go to 6,600. I deployed at 7,700.
Nice.
So this was personally, so that was a good win. But professionally, I think the biggest win has come in, I think was able to play the value rally which has happened in the last 2.5 years reasonably well. So
nice. And favorite financial app or tool?
So I use IND Money for a lot of my personal finance. So I guess that.
Okay. One piece of advice for new investor?
I would say 2 pieces of advice. One is stick to your long-term goals. Don't try to time markets. And 2 is diversify.
That's all, Mr. Shankar. I had a great time asking you all these questions. And thank you so much for sharing these valuable insights with us. But I have one more left.
Sure.
This is for the young students out there. I'm someone from a commerce background myself, and finance is a universe. It's a diverse space. And how would you advise someone on picking, you say for example, quant? It could be fundamental analysis. How would you help them guide? And also tell me, how would you help someone get into the investing side of things?
Yeah. I guess if you want to get into quant finance, particularly, it's important to have a good handle on the quantitative or statistical side of it as much as the finance side of it.
The B.Tech helped for you.
The B.Tech helped me.
Yeah.
Yeah. And the B.Techs that are being minted these days are way sharper than I am. So they do a much better job than what I did. But yeah, so that helped me. But you need to know the finance aspect of it as well, because you can be great at the technology aspect of it, the statistical aspect of it, but if you can't find a real life application for what you want, how do you trade it? How do you make money out of it? How do you profit from it? That's the challenge. So hence having a good grasp on finance, or at least being that person who understands finance, even if tech is your main calling or the main forte, differentiates you from someone who's only good at tech or only good at finance. I think that's one good way to kind of get into the space.
Okay. And that's it, ladies and gentlemen. Thank you for watching, and we'll see you in the next one.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.